say if the numbers are going up there. Yep, there we go. We're good.
Yeah, fine, okay.
Yeah, if you wouldn't mind, thank you so much.
Yeah.
Oh, let's sit down. I'm done. Yes.
Yes. Do you want to go on?
So yeah, can I go on the end? Is that all right? Then I can pop up and down. So should we start, Paul, this end?
Paul Federer from Sarasin Partners.
Do you want to say something?
About what I think is interesting. I think the biggest, I think the biggest challenge for investors is actually the obvious one, which is climate change and how you think about that. It's one of the biggest risks out there to society, but also to the investment. I think as fund managers we probably see it as one of those risks that is quite difficult to price today. So therefore, there's a tendency in the market just to sort of ignore it. It's one of those, yes, it's going to happen, but I don't know how to think about it. So therefore, I just sort of find the problem's too big to focus on my daily stock picking. So I think that's going to really change over the next 10 years. And the approach a manager takes to talking to companies about the way they're adapting to climate is key, and we're doing a lot of work, starting obviously with the oil companies and really exposing them, because if you look at their report and accounts, they don't even talk about climate risk, and it's one of the biggest risks to their future. They should be setting out a strategy, they should be talking about the risks, and first of all disclosing the information, secondly relaying a strategy as to how they're going to respond as a business to it, and they frankly just don't. So that's a big thing for us and something we're very local on, and I think that's going to be a big issue for all clients. I think there's different ways to address it, and managers will have to form strategies to do that.
Okay, lovely, thank you.
Simon Moon, Unicorn Asset Management. We launched a ethical version of our income fund about 18 months ago. And what I found when we were launching it, I think this is probably an observation on the industry, is we found it really difficult to, as newbies to it, we found it really difficult to see what the direction of travel was with standardisation of glossary or any sort of standardisation of the types of funds that are out there for investor education and for investor understanding of the wider sector. I'm not surprised that a recurrent theme has come up through the talks today in getting investor understanding out there is particularly difficult, because I think there's all these terms bandied about, and you go on the street perhaps or most probably won't know what the difference between one type of fund or one type of approach or screened or thematic necessarily is in this particular instance.
You just heard from me, but I think one of the challenges, just picking up on terminology, is also which is a good news story but makes it more difficult for the sustainable investment industry to differentiate itself, is that inexorable process of integration. So mainstream funds are picking up on a lot of these things and thinking this is common sense, this is good business sense. So are the needs of investors, asset owners, met through mainstream, or do they have to look elsewhere? And you're seeing the same trend in industry. So, electric vehicles, you used to have to go to Tesla, but now every mainstream manufacturer is doing what they're doing. So it's a good thing that a lot of the mainstream is becoming cleaner and greener and more ethical. But does that mean that the specialist firms are being marginalised?
I'm Claudia Quiroz from Quilter Cheviot. We are a discretionary fund manager, and I run our sustainable investment strategy, and it's both a fund to give us the track record and promote the strategy, but more importantly, running individual bespoke portfolios for our clients. And what I see more and more is that we are very good at managing families' portfolios, and the Generation Y is coming very strong to tell their parents that they need to look at how their wealth is going to be sustained and how their wealth is managed. And this is how we get the interest in investing in companies that are doing something that is to solve problems, environmental and economic problems of the future. And that it could be carbon, that can be energy efficiency, that can be providing water to emerging markets, and examples like that. And one of the comments across the presentations, and I think that Simon was mentioning as well, is definitions and how we name things. And that is one of the issues that you as advisors and we as discretionary managers need to understand what everybody means by a sustainable fund, by a thematic fund, by ethics, and also understand what our clients expect, and there isn't a one-fits-all, there isn't one-size-fits-all. We need to be a little bit more discerning and understanding what managers mean by their titles of funds, choosing titles.
Stuart Ryan, Money Dispensing on Research. Following on from what everyone else has said, really, it's a case of trying to, how rating funds is to try and separate out ones actually saying what they're doing is what they're doing on the tin. So everyone can say they're doing ESG integration, this, that and the other. Are they actually doing it? And that's part of our role, is to go in and see whites their eyes and do your due diligence. So when you guys are building portfolios, you know you can sit with confidence that work's been done. And following on how you said, there's so many acronyms out there, it's confusing for people, and it's a subjective area. So SI can be sustainable, can be social. These things need clarification, because for you guys trying to understand it, we're doing it day to day, we know when we're talking to each other, but if you're just coming in from an outside perspective, it is very challenging.
So Peter Webster, from two hats actually, Visio IRIS on the one hand and the EIRIS Foundation on the other. So with the Visio IRIS hat on, I suppose the thing to drop in is this whole SDGs conversation. So the Sustainable Development Goals that the UN has agreed 18 months ago. I'm on the PRI board, and from that perspective, there are just huge numbers of big investors trying to think, how do I apply the SDGs to what I'm doing? So they set out 17 different areas of activity that are supposed to channel the global economy, if you like, and they provide a whole series of things that companies need to do to improve their behaviour or to invest in new products and services which investors can get involved in. So I actually agree that carbon is the most important thing, but I think coming up the track is going to be that SDG thing. Carbon is one of the SDGs. And I guess for Visio IRIS that's kind of like good, because our methodology is all based on international principles in the first place. So if investors will start to focus on what these international trends are driving them towards, then the research that we do on 4,000 companies will prove to be useful. And that's actually one of the other confusions in this field. There is a surprising lack of correlation between the ESG scores from different research providers. So I think people in the field will need to understand what is the philosophy behind the research that they're going to use to make sense of what they see. But let me just say about the EIRIS Foundation, it's not so much a problem, it's that the EIRIS Foundation is setting out on a new strategy now. It's the biggest shareholder in Visio IRIS, but it's now separate from Visio IRIS. And one of its 4 strategies is to precisely look at this retail ethical space and to ask the question, what is a good quality retail fund, and how can we scale up retail funds? We totted up the total value of funds last week at 16 billion, whereas it was 15 billion the year before, which is good, an extra billion. But quite a lot of that is growth in asset, the assets have gone up in value. It's not huge flows of new funds, and yet we're hearing loads of trends that ought to mean this is a kind of twice as big in 3 years sort of market. It's not quite happening, so we're very interested in exploring with others what will make it bigger. Are the funds we've got the right ones to scale up massively, and all that kind of stuff. So I guess there'll be loads of conversations with other people in this room about that as we develop that strategy.
Adam Robbins, Triodos Investment Management. Really following on from what everyone else has said, the biggest ones for me are around the confusion around terms in this sector, impact, sustainable, responsible, etc. And linking in with that is the fact that that makes it extremely difficult for yourselves in this room, because you are the key to us attaining those sustainable development goals. The money is out there, it's invested, it already exists, and we need to try and encourage more people in the mainstream to start taking part in this arena, and that's how we're going to make up those shortfalls. And I agree that carbon is part of it, but there are 16 other ones in there that are absolutely key as well. So we need to work together to look at how we position the funds, how we compare them, how we label them, how we rate them, and how we talk about them in order to actually achieve those sustainable development goals.
Yeah, Simon Howard from UKSIF. I spoke at the beginning. I agree with everything which is being said. I think something we're beginning to look at, and we'll have to factor in the future, is the cost of doing this. Peter's already alluded to the difference between what the various research houses say. I think it would be a brave fund manager who only used one, so the cost pressures there. I think the investment model for fund managers, I'm an ex-fund manager, I've absolutely no doubt it must be evolving already, so that the guys can access the different pools of knowledge which are now available to them. So, we're beginning to look at how the industry will evolve, how the services you need to sell to the end clients will be delivered. There's going to be changes there actually inside the fund managers, not only the product range.
Mike Appleby from Liontrust. I'm one of the people that is involved in running the Sustainable Future Funds. And I guess one thing, I'd be optimistic, and I think that everyone wants clarification, etc., but you can get stuck in a cul-de-sac of redefining and redefining, and actually, if we use this screen themed and engaged, it's enough to get you a pretty long way with rating agencies who are looking at this. There's lots of money already going into this space, and I don't want everyone to go away and think, oh God, that was really interesting, but it's so complicated, I'm never going to be able to get someone in. I think in 2016, it was 17% of net retail sales went into ethical funds. It's a lot going in. It's a bit of a bumper year, admittedly, but there's a lot of money already going in. So don't wring your hands and get too worried about definitions. I understand that it's a bit tricky. I think the big thing that we're going to see, and maybe this will help differentiate between specialists and larger houses that are newer to this area, is us being challenged by our clients about, so what? How different is your portfolio to any other mainstream portfolio? And I think it's come a lot initially from our continental clients, but SDGs, Sustainable Development Goals, people beginning to think about how is your portfolio any different than any other UK portfolio? And I think that's all about transparency, and I think it's also about going on quite an interesting journey that's really trying to quantify to what extent the companies you're investing are genuinely making a positive impact. That's my observations.
So Bryn Jones from Rathbones. I'm going to take it from a slightly different angle and think about some of the plumbing of getting some money into the universe. And I think some of the plumbing from the old endowment models, there's still, the taps aren't being turned on. Now, I don't know the solution to that, but I've been a trustee of a large charity, and I see trustees of large charities, and they're still stuck in the old endowment model, where they're not investing necessarily in sustainable and ethical models. Now, I don't know what you need to do to open that tap, to allow some funds to come into this space to help grow it. And I think the other bit of the plumbing that's broken, and it was alluded to, I think, in my first session, is that we don't have a development bank in the UK. So in Germany, you've got KfW, in France, you've got CADES, in Norway, you've got NIBCAP, you've got EBRD, you've got World Bank. I know there's supranationals and multinationals. But we haven't got a development bank, and it's going to be very difficult, I think, to continue to grow the investment universe of which we can all invest in, particularly if we've got a UK focus. So I think there are kind of areas of, big society capital and access are trying to address that in some sense, but they're not going to be the solution to the whole ESG issue. It's just a small microcosm. So I think they're the things that we need to concentrate, not necessarily on what we're doing, actually what's going on in central policy and outside of what we're doing in order to help the market grow. So it's looking at it slightly different.
Thank you. Can I then just turn it round for a moment and see questions from the floor and thoughts from the floor on that topic, or for that matter any other burning issues of things that have been missed? Go ahead, Richard.
It's Richard Essex from Roadside. Yeah. I just a thought really. I do a newsletter for my clients every 6 months, and I think what I try and do is sort of show them what's under the bonnet of all these things. And I think Mike's point about transparency is really important. You've got to kind of make it come alive for these people. They don't talk in our terminology. They want to see actual case studies of where they're investing. And I would like to see, it does happen, but I'd like to see a bit more of that from your industry. I'd like to see a little bit more of writing in kind of making it come alive for clients, because they don't get SDG goals. Okay, the more educational of them, they might read about them, but they want to kind of just get an idea, because the thing is about the mainstream, you don't get that at all. You'll get the top 10 holdings and that'll be it. So, I just think there's an opportunity to actually say to people, look, here's some examples of companies we're investing in. This is what we're doing, and I think that really makes a difference.
Can I just respond on that? It says two things. So one, we do a case study.
Yeah.
And we send it out, which is very much a touchy-feely thing. But I think what there's a social impact card report that we're trying to work on, and actually I think we should all engage as managers, because if we can create some consistency there, and the big issue is that we're all going to do things slightly differently, right? And then you end up with this situation where everything looks completely different, you're not quite sure. And I think it's quite important for us to engage with each other to create a standard when it comes to sort of the social impact goals. And you know, clearly there's the touchy-feely approach, which we said, where we can do case studies, we get pictures of us with in certain scenarios. But I think on the social impact side, I think we should all sit down and come up with a solution for that.
I mean, I'd be happy to pull people together for meetings for that kind of things. If you guys want to sit around a table and discuss that, you know, I can convene that. And
we've got, as I say, that Access and Big Society Capital are keen on doing this as well. So I mean, it'd be good for all of us, I guess.
Oh, that's a great idea. My concern to some extent is that if you start putting loads of emphasis on impact, you start to. My fear, I remember, you know, back in the day when I put out example case studies, people would assume that that was what the whole portfolio was like, and then when they looked at the portfolio, it wasn't that interesting. So I always worry about mis-selling risk of that kind of thing. So you've got to word it carefully. This is an example of a great company. Bear in mind, you know, a lot of our other companies are blue chips, whatever, that are just managing things well or whatever. So yeah, but yeah, great.
I wanted to follow, just a quick follow-up in your comment, Richard, about the end and the Lion client. And that's what I know when we meet clients, the family, the parents, the sons and daughters. We talk about, we say, those holding, those companies that you will be proud about to discuss in the dinner party conversation. And it's not about the jargon. Yeah. It's about having a connection, related, a relationship with what they are investing in.
Yeah, maybe it's interesting just to comment on this, the impact thing that you mentioned, Julia, that obviously the people who focused on really big impact investments, and then everybody gets excited about impact, and everyone else says, well, hang on a moment, all the things we've been doing all these years, they have impact as well. Yes. So we want to, which is actually true, because I mean, they are investing in companies who make stuff that has impact, and they are trying to change the way companies operate, which has impact. So we've got to find ways of explaining the differences, but they are all related to impact. I saw a very interesting example with Storebrand in Oslo, actually, where they explained their fund by adding up all the slices that they held of all the companies, and then saying what it would be like if it was one company. So, you know, this company would have 100 employees, it would pay its half a director this much more than, and it would put out this much carbon, it would do that. So they kind of aggregated their fund into like, and pretend it was one company and explain it to someone, say, is that the kind of thing you'd like to invest in? And here's how it's different from the average fund.
Scott, yeah.
I was going to say, from an advisory side of things, possibly one of the best things that could actually happen is actually some complaints going to the Financial Ombudsman Service about the ethical or social responsible questions not having been asked by us advisors. We were speaking earlier on about it's very hard to encourage your peers to be asking the right questions. The responsibility that is there to get to know your clients. That if you get to know your clients, some of the themes that have been coming out of here, the clients have got interest in electric cars, the clients, and they just don't know that that's sustainable energy. They just don't know that those options are actually out there. So the best thing that could possibly happen is some upheld complaints going to the Ombudsman Service against advisors who haven't actually asked the question, because so much at the moment is focused on attitude to risk. Attitude to risk about the actual volatility of the fund, not about attitude to risk. As I've forgotten your name, tell names. Claudia was saying, if you've got a grandparent client who hasn't thought about ethics before, it's the being proud about when that grandchild inherits the actual investment, the grandchild says, I don't want anything to do with that. So it's actually, and the other thing I was going to put down here, well I actually put down here, is the average age of advisors is problem, and the average sex of an advisor is a problem. Yeah, most of us are male, still, ladies. Yeah, most of us are male.
But it's like the panel. There's only one lady on the panel. There's only one lady on the panel.
And that is a major problem because we're not actually engaging with nearly 50% of the population and having those conversations. And those conversations aren't happening with advisors on the whole. So it's not you lot. You can do anything you like, but you're not going to make a difference unless you engage with the people who are not here rather than the people who are here.
Yes, we.
Yeah.
I try and put
trying to persuade with one IFA firm, my locum does a lot of the research, and I'm trying to say to them, look, Liontrust is actually coming up with performance figures. Why isn't Liontrust on there? And he's saying, but it's not happening.
We quite often see a lot of investors who like shocked that we've got really good performance and haven't put us on the radar because they've excluded all funds that have got the word ethical in.
Yeah. So it's a new model advisor article this week, wasn't there, actually showing performance of ethical funds and socially responsible funds. And clients don't know what an ethical fund is, and clients don't know what SRA is. I did put on my hand on some of those questions. Have you heard of this? Well, I might have done, but my clients won't have a clue, even though they've met me, what we're talking about. It's far too much jargon. The clients want to know what the issues are. Give them a list of the issues. They say, I thought you were avoiding that already. So that's just an observation.
Yeah. Absolutely. So a couple of thoughts on that one. Actually, loads of thoughts on that one. I could talk on that all day. When I was an UKSIF director, this predates Simon, we were having a big push on exactly that kind of stuff. And I ended up doing some training at the FOSS, and it was good. Because I had a load of them sat in front of me going, oh, I didn't know that, a whole room of them. And that hasn't been done for 10 years, as far as I know. So that was, early 2000s I was doing that
Don't
stuff.
Engage with the FCA. It's the ombudsman that advises the
Yeah, absolutely, which is why...
anymore. It's the ombudsman we're fighting on.
Yeah, so, if anyone here's got any ideas how to get me in to do a training session with FOSS again, I'd more than happily do it. We were just I was just trying to explain to them just the different strategies. Just, broadly speaking, we know people are interested in this, we had all different research at the time, but it wasn't so different from the stuff that Simon does now. We know people are interested in this stuff, and they have been for years and years, and it just, although, institutional stuff has shifted really fast, but advisors are way behind the curve. So when I first launched Fund Eco Market, I had it as a kind of login thing, and you went through almost like a regular tool that you might find on an IFA's own site. And it seemed to me that no matter how hard I tried on that method, getting people to log in, whoa, no way. So that all had to get scrapped. Sponsorship from fund managers, make it more jazzy. And so, the information's there now. These guys will help me by supplying information. And most of the fund managers in the room here help me fund the thing. So, yeah, just if anyone can find ways that we can get into the likes of the FOSS. Guy?
Could I ask a question to the IFAs in the room?
Of course.
And ask them to characterise the kind of clients that are interested in these funds. And is there a pattern there, or is it so broad it's impossible?
90% of clients, we give our clients a list of most of the negative screening criteria, and 90% of them will end up with at least one thing on that list that they wanted to avoid in the first place. So if you approach it from that point of view, I was saying earlier on, the government have enforced auto-enrolment. Okay, so auto-enrolment to pensions has come in, so that's entry by default. Well, ethical and socially responsible investment, it should be screening by default and choosing to actually remove those screens. It's just we're actually approaching it completely the wrong way round. That's what the government have realised with auto-enrolment. I didn't know I got a pension until I was 21. I'd actually had a pension for 3 years, and that's what clients are like. They don't know that their money isn't being ethically screened.
The ones that care about it, how would you characterise them?
Can I just add that? I'm not an IFA, we're a wealth management firm, so not sort of only similar. It's not what you show them, it's what you ask them. And it's how you get to know your client and how that client then gets to know themselves and how you represent their story in the portfolio. So the whole onboarding process is fundamentally flawed across the industry. So we lead with people's values, we lead with people's passions, their thematics, and then we bring in some of the, the more regulatory issues around risk and return at the end. So we get a really comprehensive 360-degree view of the person, and then we build their financial arc around those kind of parameters. And we're finding it's unbelievably popular with women. So we have a really lovely sort of 50-50 split in our clients between genders, which is great. Families really like this. It's a really interesting way to get a family to engage in what the family's values are and what the legacy needs to be. And then, you know, I hate to say it as well, you know, there is a real predisposition amongst those under the age of 45. So not technically sort of the millennials, a little bit broader than that, but they're really responding to that as well. But actually, this is a mindset. This isn't a segment of society. To your point, when you present people with the opportunities for them to do good and do well, you know, it's a very unique person. You know, will turn around and say, I don't want to do this.
I would endorse that. I mean, I come from exactly that angle, that I do a lot of reviews with clients. I mean, I've got to be honest, I guess most of my clients tend to be 45s and above, but that's not to say I don't do the younger clients. And it's a way of, you introduce it into the conversation. I mean, I do a lot of reviews, holistic reviews with clients, and the things that come up is, what do you want to do when you retire? A lot of people want to travel, so you talk about their values, and then you build in the whole concept of, well, you know, do you want to do something positive with money as well? Well, what is that? Then you talk about it. So, as you say, it's a conversational thing, and I think it's, I would say 75–80% of my clients now I put into SRI portfolios because they're performing better anyway. Yeah. So it's just kind of, most people actually don't, well, this is my own personal preference, are not that picky. Oh, well, I don't want this and I don't want that. If you say to them, if that money's moving in the right direction and they're investing in companies that are kind of thinking the same way as them about the bigger issues, they're happy. You know, and I think sometimes we get too wound up about, oh, we want to do this or that.
Well, the interesting thing was that when I was I went to a conference in Paris, and it's actually interesting that most of the French actually, even if they're not an ethical fund, will have a sustainability screen. And I'm wondering if that might be because of the risks of legislation if they don't do that.
Should we pass that one over to Peter to comment on?
Well, it is also actually the Visio side of Visio IRIS is a large part of the reason for that, because there was just a big move amongst French financial institutions, which culminated in the creation of Visio, really, to say this is something we're all going to do. So if they've all decided that they're going to do it, then...
The Article 173 stuff?
Yeah, and then, so the Article 173 is the well, the due diligence law comes after that, actually. Article 173 is the thing that gets people to work on the energy transition. And all French institutions then have to report to their regulator. So it's not the Ombudsman in that case, it's whoever's regulating the financial institution. They have to report what they're doing about carbon exposure, energy transition risks, all of that kind of stuff. So they tend to go for it more at a kind of state level in their French setup.
So I think what we're finding is that the clients are shifting a bit. It's no longer just giving us a list of what to exclude from the portfolio, they're actually coming out the other way and saying, you know, you, the fund manager, you take responsibility for running a responsible portfolio, and you decide what that means.
Yeah.
These are my values as a charity or as an organisation. I'm not worried about poverty relief or whatever charity is involved in. And therefore you interpret your portfolio and make sure you don't embarrass us. When we look at the holdings, we're surprised to see these don't really fit with our values. But it's less, to me, now being written down on a piece of paper as a list of don't buy tobacco and alcohol. It's more you, the fund manager, interpret what you think is responsible. And if you don't think investing in Facebook and Amazon is a responsible thing to do, then don't do it for us. But the onus is back on our side as fund managers to make that sort of decision.
Well, just to go on Bryn's point, I do think the risk factor is an issue, and you know, I just think there should be, in a not too distant future, enough information coming in to back up the fact that ESG is a risk. If you don't look at it, and I mean, the best, you know, wouldn't it be great to have a risk questionnaire that actually incorporates ESG as a risk? Because as far as I can see, it's a risk. But there doesn't appear to be enough information, enough data yet to really back that up. Certainly as far as the FCA is concerned.
But you have to look at it in both. You have to look at both sides of it. According to the data we had, you do run more risks, depending on how you define
Well, that was
which segment you're looking at.
Yeah,
So
I accept that.
not all is.
It's not as straightforward as that. I appreciate that.
In the long term, yes, but when you start to